Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We are trying to help everybody have a more successful financial retirement. We do that by answering questions. So you can send in your questions now to Ask Tom with talkmoneywithtom.com, or even put them into the chat here if you'd like, and we'll answer those live. You can send the questions in during the week. And then we get a lot of questions from clients that we share with the audience here too, so because we think they're important. We believe that the more that you know about these subjects, how to manage your money in retirement, your retirement plan, your, tax planning, especially during your retirement, the better your retirement will be. And these are subjects that you can look at whether you're already well into retirement or quite young looking forward to your retirement. These are things that can help you kind of get, to where you'd like to go financially. And so, of course, you can subscribe to our channel if you'd like, which is the, subscribe button and the little bell there too if you'd like to get notified when we put in something new. We have over 1,000 videos now on the channel. You can peruse those. A lot of content that we try to create here to help you out with your retirement. And then, of course, you can always meet with Ethan and I one-on-one. We can go to our calendars live on our website. So you go to the book appointment button on the top of the website, and you can pick a 30-minute time, video or phone, to chat with Ethan and I, and we can maybe answer some of your specific questions that way. So really looking forward to being able to help you today. Very excited about some of the questions that we already have, and look forward to being able to help you find at least something today that might get you farther down the road on a successful retirement. Of course, I always like to start off the week with a summary of what I saw happening with the stock market this week. And if you look at this chart here, we've got the year-to-date S&P 500. The little blue line there is the 200-day moving average, and that red line is kind of the trend line that's connecting the major points as far as that goes. If you look at what's happened most recently, just over Ethan's head there, we've had quite a run-up here. And what happened was, for this week is very interesting because early in the week, Wednesday and what have you, we started to see the potential for something breaking. And we've been talking about something breaking for quite a while because of the fact that, you're tightening up money supply, you are raising interest rates, and something often breaks. And we saw, one of the exchanges within the cryptocurrency world basically faltered and has now been, seized for all intents and purposes by Bahamas authorities. And so the market had dropped a couple percent that day. The next day, on Thursday of this week, the CPI report came out. And here's what it showed. And you can see by that big green bar there, right over Ethan's head, that it was a good report. We were up 5.5% yesterday on the S&P 500, which is a really big move. And then today we're following through. We're up a little over 1% already today also. So it's good to see follow through as far as that goes. So this is the CPI report for the last 12 months. And so you can see, we peaked out there in July and really kind of coming down. But this last piece is 7.75. The consensus, and this would have been for last month, for October, the consensus was that the inflation grew at 7.9 to 8.1%, depending on what you were looking at. And so coming at 7.75 was a big surprise. That's why the market moved up. Mostly you see these market moves that are really strong like that because there's so many people shorting the stock market, expecting things to continue to go down. And then there's a surprise to the upside, and they have to, go back and buy those stocks back, to cover their shorts. And of course, when they do that, that raises prices even more. We saw a lot of companies that had high short interest do extremely well yesterday. But not to diminish the fact that the stock market did go up substantially for that one day, because sometimes a short covering, I'll put this out there, the next big rally that comes, if we go back to this chart here, the next big rally that comes and changes that 200-day moving average to up and breaks through that red line there, it will probably start with short covering. I mean, that's kind of how it all starts. Now, unfortunately, we've had so many examples where short covering has rapidly moved the markets up this year, and then it's fallen apart again. But that is a big deal. That's kind of how it works. And here's core inflation. So the chart for core inflation, now core just means they take out energy and food, all right? The chart for that, it doesn't look quite as good because it's actually been going up for a couple months in a row. It's now down to 6.3%, which isn't bad, but it's still kind of high. And core is more important to the Federal Reserve. It's more what they look at. And actually, the measure that the Federal Reserve looked at is called PCE, which is Personal Consumption Expenditure Index. Now, this isn't reported until the end of this month. So the chart here is actually showing for what happened in September. I would expect that October would come down. And the only reason I really show this is because a lot of people say, oh, inflation's at 7.75. The Fed has to go all the way down to 2%. There's a long ways to go. No, the 2% is core PCE, which was at 5.1%, probably drops down into the 4s once they report it for October here at the end of this month. And so still quite a ways to go, unfortunately, to get from 5, 4, high 4s, whatever it might be, down to 2%. But it's not as far as what a lot of people are thinking, having to come down from this, overall CPI inflation report. And so this is the measure that they look at as far as that goes. So I throw that out there because I think that's kind of interesting. So what does this mean for the stock market as far as we're concerned? Well, first of all, we reversed our inverse position yesterday with that strong move from a inverse S&P 500 position to buying long the Vanguard Total Stock Market Index, and we did that yesterday morning. And the reason we did that is because that move was so strong, and the fact that the possibility that inflation actually does slow down faster than expected, right? Because that's what people are looking for right now. Something to happen on the positive side. Is it enough to say, hey, it's all over and we're going, crazy to the upside now? I don't think so, but you never know. So we have about a third of our exposure that we normally would have to the stock market back in the stock market, but we don't have all of it back in the stock market. And so, there's some reasons for that. First of all, we're in a downtrend, right? I mean, so if you look at that, one of the things you look at for a downtrend is, are the highs lower? Yes. You look at those big peaks, they're all still going down. We haven't broken that yet. And that red line kind of shows that, that trend. Haven't broken through that trend. Is the price below the 200-day moving average? Yes. Is the 200-day moving average going down? Yes. So we've got to see something. Now, here's something interesting, though. Look at how close we are to the 200-day moving average now, and even to that trend. And so that's about 8% from where we are right now. So if we get another 8% in gains, we will get to the 200-day moving average. But it's important to remember that it actually has to break through with some power. It broke through in March back there and fell apart, touched it during the day in August. And so we'd like to see that happen. But there are some concerning pieces facing us that we have to kind of look at. And so first of all, we've been looking at this 2-year Treasury yield. And so the green line there is the yield, and you can see, how much that's been coming up, over this period of time here, a little over a year. And I've drawn some red trend lines in there. And so you can see that most aggressive line, the most current one, actually broke through that yesterday, just a little bit. So that's a good sign, because we need to see that coming down for the stock market to go up. And the reason is, this is a projection, essentially, for what the Federal Reserve might be doing in the future with their rate increases. So not enough to say they're going to start pausing or lowering rates, but that's a good sign. But the other longer red line there is the longer trend line. It still hasn't gotten really close to breaking that. The 200-day moving average is that blue line. It certainly doesn't look like the stock market. It looks exactly the opposite stock market, which is exactly why we follow this, because it's an inverse related component. So still like to see some more deterioration there in terms of the yield on the 2-year. We have seen some, so that's good. Here is money supply. So this goes back to 1960. This is kind of a funny looking chart, but this is M2 money supply, which is one of the components of money supply. And the thing that's important to realize here is first of all, if you look closely at that, it basically has never gone down since 1960. A couple periods of time where it kind of floated sideways and what have you. And I know it's hard to see here, but it's been going down all year, this year. So that's a really big deal. So what happens with money supply starts to shrink, it really tightens things up. And of course, that can create those types of problems where something breaks. Yeah. And so now I will say, although it is coming down, you can see how it went almost vertical there in 2020. So this was a tremendous amount of money supply pumped out. This is why we have inflation, yeah, that came out, in that time period. So maybe the combination is okay. So that way too much money coming out in a short period of time might be all right to have some downturn here, and maybe this doesn't have a big impact, but it's definitely something we would watch for because it is an important component. So really like to see that 2-year treasury coming down before we start jumping back in. Really like to see the stock market jumping back through the 200-day moving average. Love to see, money supply at least stabilize at some point in time. These are all things that would be positives for the stock market. The other thing is that we have these inverted yield curve components. So go back to July, the 2-year treasury started paying more than the 10-year treasury. So this is a precursor to a recession, and it's been under that for a long time, right? Then we go back to, just last month, and the 3-month, this is 25th of October, the 3-month has started to pay less than the 10-year. This is an even more accurate gauge of recession. And so recession would be 12 months on average. So next October, let's say, stock market would probably have some troubles with this as far as that goes. Then, just this week, this is what's called the near-term recession risk component. This is actually Chairman Powell's favorite measure of recession indicator. And what it is the expectation for what a 3-month T-bill will pay 18 months from now, a year and a half from now, versus what it's paying now. And so as of Thursday, that inverted. So in other words, they're paying more now than they will in 18 months on a projection basis. And you can see if you look back that this, went past zero, inverted, before the 2000, the big red column there, and before the 2008. But maybe more importantly here, this is the gauge that the Fed is watching the most. So here's the strange thing, though. This can go either way because the Fed looks at this and says, okay, maybe we should slow down, theoretically, our rate increases because now we have our preferred measure of recession coming, and we don't want to kill everything trying to bring this down, and so maybe we slow down the pace, or maybe we eventually pause, those types of things. So the market looks at this possibly as a positive. Mm-hmm. But then you've got the other side of this, which is that it is predicting a recession, which could affect earnings. And so how much is that recession? Is it a soft, shallow recession? Is it a hard recession? Does something break? So that's why, again, having a third of the stocks in the market still makes some sense to me because the paths that are out there, there's some good paths that are happening here, but there's also some other ones that are not so good. So you got to be a little bit careful. This is not a clean runway to an upturn here with all the things that are happening. And so, but on a positive note, there's quite a bit of upward pressure on the market during this time of the year. Number one is we just had a midterm election. We talked about this on the last show, that the midterm election is a really big catalyst for the stock market to the upside. I believe the rate of return on the S&P 500 after the midterm election is roughly 10% between that and the end of the year. So that's really strong, right? And then we also have this situation with a lower CPI that just came out. And we don't have anything else for a while. The next time CPI comes out is the 13th of December. And then the Fed Reserve does their question and answer and announcement of what they're doing with rates on the 14th of December, the next day. So if you want to circle 2 days on your calendar that are coming up, those are good ones to look at. But what's happening here is that there's a good chance that this could run in between times because there's really nothing else happening other than the cryptocurrency piece, which continues to kind of hang in there on a deterioration basis. So, again, if something breaks between now and December 13th, that could cause a downturn. But I think it's actually more likely without that we will see a continuation of this run up. And it's why we went ahead and moved our inverse to a long position as far as that goes. So that's what we see in the markets here so far for the week, and really look forward to being able to look at this again next week. All right, let's take a look at some questions.
So, what is an economic cycle?
An economic cycle. Okay, we have a slide for that. let's see here. And really, this has a lot to do with conversations that I've been having with my clients on what I call the super cycle within the stock market. And here's something I think that's interesting. The bottom of the 2008 downturn was March 9th, 2009 on the S&P 500. And then if we go through, we hit the top for the S&P was January 3rd of this year, right? And now we're ending up with this downturn. And so when we get to the bottom of this downturn, right now it's October 13th was the low point, but there could be a lower point in the future here. But at some point in time, we're going to finish that. And that's called a super cycle. So really what you want to do is look at your rate of return during the entire super cycle, because that is your rate of return, because that's how this works. And so this economic cycle, business cycle fits into that exactly. So you can see there's expansion, then peak, then trough, expansion, peak, trough, et cetera, contraction. That is the stock market. That's exactly what's happening. So from the bottom of that trough to the top of that peak, for us it was the 9th of March 2009 to January 3rd, 2022. That's the expansion portion. And now we're getting into the contraction. Where the bottom is so far, October 13th, but your total rate of return is from trough to trough. That is your rate of return. So, if you look at the S&P 500 during that time and see what rate of return it has, it's positive. Even though if you look at your returns for this year, you think, wow, the market's terrible. If you look at your returns for 2020, for example, you think the market's great. Both of those are misleading. This entire super cycle that you have to be aware of, and you have to be able to kind of invest within this situation. And this is normal. This is how this works. I would say that we're seeing compression between these cycles as far as that goes. At least with the stock market, we had 1929, 1975, and 2000 were the big peak trough cycles that happened, and they were 35 years apart, right? So the super cycle is very long. Computers, all these things are coming along, and all of a sudden we go from 2000 to 2008 to 2022, and we're seeing compression of these super cycles as far as the kind of the economic cycle goes, and that money moves faster. There's all kinds of things that happen in this particular environment that creates that. I would expect that this is going to be a continuation where these things happen more frequently than they used to. The stock market's still making money, but you need to be able to understand how to handle that peak to trough, which is what we're doing right now. Do you stay in for the whole thing? Can you afford to do that? Do you get out for a while? Do you take a piece out? Those types of things. So, our outlook is that you really want to stay in if it's less than a 20% drop, because those happen quite often. And it's probably not truly the big correction that you're talking about. Once you get past 20% down, it's time to get more defensive in your manners, and that's what we did this year. So, anyway, we'll see what happens. We don't know where that trough is for sure in this particular situation that we're in. But the economic cycle is important to understand. These super cycles within the stock market, I think, are really important to understand also. So it's a really good question.
Yeah, and some people just trade different stocks based on the time or what they think the cycle is. Expansion, you try and go for more growth stocks, and contraction, you go for more value stocks.
That's right. Yeah, exactly right. So, and that's been true this year. Value has outperformed growth, and so that's the key. And we have seen when this year, for example, when the market has run up, growth has started to outdo value. So it looks like the next expansion, and we saw that yesterday, right? It looks like the next expansion might be more growth-oriented, and that's kind of an important component of what you do. So as you see that peaking motion happen, starting to switch over to more value-type stocks, as you see that trough motion happening, starting to switch over to more growth-type stocks, we buy the whole market with most of our portfolio, 76% of our allocation to stock is in the whole market. And really, we're just messing with that other 24%, that what we call our targeted indexes. So we might have more value, more growth, or more different types of things in those. And I think that's a really good strategy there, because you really can't tell all the time where you are. Is this the trough, the peak? You can look at it in hindsight and see it quite easily, but that doesn't help you unless you have a time machine. So really, the key is to have most of the money invested in these broad indexes. I mean, we just moved back in, tens of millions of dollars back in the market. We bought the Vanguard Total Stock Market Index, which buys essentially the entire U.S. stock market, large cap, mid cap, small cap, micro cap, you name it. So, and that's just because, we believe that the overall market is the place to have most of your money and not try to guess in that regards, and then, some of the targets they're after. But yeah.
With China easing their COVID policies, what does this mean for the global stock market?
Okay, so China eases COVID policies. You're looking at, number one, most likely an increase in energy values, because China is one of the biggest users of energy in their production capacities. So you might see some of these, ETFs like Vanguard Energy or whatnot, Spider Energy, XLE, and VDE for Vanguard do quite well if they start to move off of their COVID restrictions. It most likely means that the stock markets see the potential for a higher level of supply. So this inflationary environment that we're in right now, one of the big problems is the money supply grew dramatically. Demand grew with that. Supply couldn't even remotely keep up because it's actually even lower than it was in a lot of places. And so when they close down factories in China, that brings down supply even more. It creates more inflationary pressure. So if they're going to come out and say, hey, we're going to do this and this to try to deal with that and not have as many lockdowns, then you're going to see the stock market move up. Obviously, the China stock market moves up, but even the U.S. stock market and European stock markets might move up because, again, inflation is the biggest issue that's happening right now, and they're contributing to inflation by locking things down because they're restricting supply. They're the world's, manufacturer for all intents and purposes. Now, that might change some point in the future. A lot of talk about looking at other places, but nonetheless, at the moment, things are still coming out of China. So that's good news. That was today. Yeah.
Yep.
Yeah, that's good. We'll see what happens, right? It's a tough situation because if they let everything just go, they don't have the hospital capacity, right? And that's what they've said. And they don't have the vaccine in place either. So it's going to be interesting to see what they actually end up doing.
What's the difference between a refundable and non-refundable tax credit?
Refundable versus non-refundable tax credit. So a refundable tax credit would have been something like there was a child care credit, I believe, where if you owed $4,000 and your credit was $5,000, you would actually get a $1,000 check back, like a refund. Versus a non-refundable, which is probably more like what we saw with the electric vehicle, $7,500. If you owe $4,000, you have a $7,500 credit. You just get to write off the $4,000. And is that a use it or lose it scenario?
Yeah.
Okay.
So most of these you don't roll over. There's no carryover. So sometimes you do want to take more taxes.
Yeah, that's that. We have a case that came into this week where somebody has a $7,500 credit and they don't pay that much in tax for a variety of different reasons. And so we're trying to figure out how to make sure that they generate at least $7,500 worth of taxes owed so they can use their whole credit. So in that particular case, we're actually looking at converting assets from an IRA to a Roth IRA and creating enough taxable income to, let's say that you do that and it creates $7,500 worth of taxable income. You can then use your credit to basically pay that tax. Now you've got that money sitting in a Roth going tax-free thereafter, reduces your RMDs your required minimum distributions going forward, et cetera. So there's some strategies that you can do around these different credits that are worth looking at.
Yeah, and some of these credits could be a hybrid. I think the American American Opportunities Tax Credit is a hybrid one where a portion of it is refundable while the bigger part or another part is non-refundable. So it depends on the situation.
Yeah, it's kind of interesting because the non-refundable ones are fascinating, and lots of our clients try not to have a tax bill at the end. Withholding or quarterlies or whatever they're doing, they're trying not to have a tax bill. They don't want to have a surprise and such. And so all of a sudden you got this $7,500 credit. you really got to think about it and reverse all your thought processes to make sure you owe at least $7,500 at the end. Otherwise, you won't get it. So yeah.
So, what does FTX's bankruptcy mean for the stock market as a whole? We've seen how it has shockwaves through the crypto or the stock market, but does it, kind of become a Lehman Brothers or something like that?
FTX's bankruptcy is really fascinating. For me, I'm not an expert on cryptocurrency. I struggle with the concept of, what's behind it, right?
Yep.
I'm so used to, analyzing companies and indexes and ETFs to see what's behind them. What's behind Apple? What's their product mixture? What's their cash flow? What's their cash position? What's their debt load? What's the expectation for future earnings growth? Those are all things behind it. I can't see that in the crypto world. So, but what is interesting to me about crypto is what type of relationship does it have with the stock market? So, obviously, it is moving in the same direction as the stock market. It peaked out roughly the same time, has fallen during the same periods. It moves more than the S&P 500, so it's like a magnified version of the S&P 500. But can crypto falling apart bring down the stock market? This is the number one issue that I now ask myself all the time, because credit default swaps were sitting out there with $7 trillion in them in 2006, 2007, and these are insurance policies on top of mortgage bonds. And so once mortgages start to default, these companies had to pay off on these insurance policies, and they had to get their money from someplace, and so they started selling stocks and bonds to do that, and we ended up with the 2008 financial crisis and downturn. And so can cryptocurrency be that? Well, it's a little bit unclear. I will say, when we look at the days, there was Tuesday, stock market dropped 2% intraday on the news of that scenario. And then Wednesday, it dropped a total of 2.3, I believe, percent on the continued news of that. Basically, FTX, was supposed to be bought by Binance, and then they backed out of it. And Wednesday is when they backed out, and the market fell. So there's definitely some concerns within the market. And my question is, and this is something that you can't really see, we'll just have to watch and see what happens. How much of that leverage is out there in the cryptocurrency world that if the price of cryptocurrencies come down, the leverage, the margins get called or what have you, how many of those people have to sell other assets? And so specifically hedge funds. So they've got this leveraged Bitcoin, cryptocurrency, whatever cryptocurrency it might be, and that gets a call because it drops in value. Do they have to then sell my Apple? That type of thing. So, that's what happened in 2008. So certainly something we watch for. So far, you were talking about that this morning, but they're looking at it more like an Enron instead of a Lehman Brothers.
Yep.
Because Enron failed and the market didn't have a real big problem because there wasn't a big connection event that happened there. Bad for Enron shareholders, right? So I hope that's true, actually. And I think that's probably true, honestly. There is definitely some motion happening with the problems in cryptocurrency, but there needs to be a stronger connection. So credit default swaps had a really strong connection all the way through the financial system. So when they failed, everything went down with it. And when Lehman Brothers failed, that's what really catalyzed everything and got it moving in the right direction. I would bet that what they're talking about is probably right, and I hope they're right. Because I don't want to see another Lehman Brothers event happening.
Yeah, and you can think about crypto's market cap is around $850 billion. Right. And so it's not the $7 trillion.
Right.
And
that's right.
You can see that the market's still going up, even though crypto is now going down. So for today, it's down. It's still in the red, but the market's in the green.
Yeah, exactly. So that hopefully it's self-contained. In that regards, we'll see. It could be a really, it could be a big contagion within the crypto arena. Maybe this FTX thing isn't the last thing that happens, and there's this kind of cascade. I mean, because we had 3 companies basically go out of business in May, and so now we've got this one happening here, and what connections do they have, and how does that continue to bring down that entire universe? I wouldn't be surprised to see cryptocurrency implode because I still don't see what's behind it, but it doesn't mean it will.
Oh, so this question comes is, I'm in my first year to take my required minimum distribution. Should I delay my RMD until April and do a Roth conversion this year? And how should I think through this process? So we can't give specific, recommendations, but we'll try and give you a general idea of how to think this through.
Yeah. So in this scenario, and this is a real world scenario, person's turning 72, so they have to start their requirement distributions. But they have this weird little quirk in the law that allows you to wait until April 1st of the next year. So let's say 2022, I turned 72. I don't have to take my first payment until April 1st of 2023, right? But if I do that, I still have to take 2023's payment by the end of 2023. So that would mean I'd end up with two required minimum distributions in 1 year. So the question is, should I do that anyway? Should I push it through to the next year? And instead of taking, an RMD, let's take some money out and put it in a Roth. Let's convert money. So I could use the exact same amount as the RMD.
Yep.
And so I'm going to end up in the same taxable situation because I can't get away from the RMD. And then the advantage would be that I've now possibly reduced my overall exposure to the IRAs, and my required minimum distribution for 2023 would be lower. And I now have this extra money growing tax-free, right, for eternity, as long as I'm alive there or till I take it out. And so actually on the surface of it, that sounds really interesting, but you have to take a look at some different pieces here. And number one is, how is that double required minimum distribution going to affect your Medicare payment next year? And so, because the way Medicare works, it's means tested. Does it bump you up into a higher Medicare where you start to lose some of the benefit that you got from getting that tax-free growth in the Roth? And does it move me into a higher tax bracket with some of that money or some of my money? Now, the tax brackets are pretty wide. So, I mean, let's say, for example, the 24% bracket goes up to $320-some thousand for a couple. And if they're at 150, and they add an extra 50, they're still paying 24%, so it doesn't change. But it is something to take a look at. Does it push me over? So I'm now paying, say 32%, which is the next bracket up over, which is a lot more on that extra money. So you kind of have to look at that from a calculation standpoint. This is how we look at it. How much does it bump Medicare, if at all? Because the brackets of Medicare are narrower than the tax brackets, right? And how much does it impact the tax itself, and what happens with the tax brackets? I think it's a really valid, really, really interesting concept to look at. And I think I wouldn't be surprised if it doesn't work quite well for a lot of people. But again, everybody's situation's different. That's one thing we have to be careful with on this show, is just, your situation is like a fingerprint. It's different than the next person. So, but we're trying to give you some of the parameters and outlines for kind of what you want to look at, how you want to think about it, and just, what's possible. So it is possible, right?
Yeah, and something to also consider is, does your custodian allow it? I know some custodians are asked for you to take your RMDs before you do any kind of Roth conversions. And so this is kind of that weird gray area.
Yeah.
And so you'd have to go through them, argue your case, and see if you could they would allow it too.
Yeah, by custodian, it's TD Ameritrade for us, and it's Schwab. It really is now going to be TD Ameritrade. It's Fidelity. It's these companies, and just from my experience in dealing with custodians, they get in a rut. It's like, okay, this is what we have to do. You can't do a Roth conversion until you take out your required minimum distribution. But really, their law says that very first year, you're going to be able to take out that required minimum distribution next year. But you're also dealing with some person or a group of people that are working in these custodians, and we've had so many discussions, let's put it that way, with that group, trying to convince them that this is the way it should go. And usually, if it's the right under the law, we get it, but it's not a slam dunk, and it can take quite a while to. So if you're going to go after this, I'd start early, because the custodian might say you can't do it.
Yep.
Yeah, you're exactly right. So, and I don't know what the rules are for this with each custodian. That's for sure. That's one thing you have to check in on.
So now that you're nibbling back into the market, what are your next confirmation signs or next signs? Are you looking for that cross on that 200-day moving average? Are you looking for that cross on the next, the trend line? What's the next steps?
Well, there's a bunch of pieces, and all of them are part of a big scorecard that we use to kind of decide, when we should be moving. And I'll tell you, one of the biggest pieces of that scorecard, the concept of don't fight the Fed is really, really, really powerful. If you just look at what the Federal Reserve is doing when they're tightening with higher rates and moving rates up, the stock market struggles and often goes down quite a bit. When they're easing and lowering rates, the stock market goes up. So, boy, that's a big one. And if the Fed got to a spot where they were lowering rates, and historically these bear markets have bottomed, not when they're going to reduce from three quarters to 0.5%, like we're talking about now. And so that's what they call pace. Not when the pace slows down. It's not even when it pauses, where they keep it at 5 for 6 months. It's when they reduce it. That's the bottom historically for the bear market. So one of the ways to kind of look at when they might be reducing it is to look at the yield on the 2-year Treasury, because it's a prediction. It's not perfect, but it's a pretty good thing to look at. So I would love to see the 2-year Treasury start to kind of deteriorate some, right? And actually, I can share the slide for that here too, just because we had that from our summary. Here we go. So there's the yield on the 2-year Treasury, a couple aggressive, trend lines there. Love to see that continue. It broke that one aggressive trend line.
Yep.
Does it break the next one? I would incrementally be moving back into the market if that happens. There's a moving average crossover that we use here. Does that crossover? That's another incremental move back into the market, right, as far as that goes. But you're exactly right. If we take a look, again, just looking at the slides from that we had from our summary today, love to see that 200-day moving average actually get through there, hold through there, break that red trend line that's there also. All of these would be incremental pieces for wanting to move back into a full-on motion as far as that goes. So Federal Reserve actually lowering rates, you got to be all in, right? But prior to that, incrementally looking at these 200-day moving average crossover, that trend moving average crossover, the 2-year Treasury kind of falling as far as that goes. And those types of things are things that I would be looking at, from a standpoint of, nibbling back in, because right now we are still in a down market. And if you are investing to the upside, which is what we just did with a portion of our money yesterday, you are hoping that the trend overall is going to change, because otherwise you're investing in the minor trend, which might not last that long. I think this one could last a little bit longer, just because the fact there's nothing happening between now and the next CPI report, and we got a seasonality for the end of the year here after a midterm that could push this higher. And so let's ride this. I hope it's the end and we're going back into a new primary trend, but we need to see some of these other things happen to really feel like that's true, because, all bets are off if something breaks. So you got to be careful there. There's a higher probability of something breaking here. So having full investment back in a down market when the Fed is still raising rates, we're still below the 200-day moving average. The 200-day moving average is still going down. The trend line is still going down. And the 2-year Treasury yield is still really on a rip to the upside, let's face it, even though it has broken a little bit of that aggressive trend. This says to me, okay, I'm going to move back in, because the market is so powerful right now, and actually CPI actually came in lower than expected, which hasn't happened in so long. Let's move back into third. And that's what we've done. Now, we might not do a lot until we start to see some of these other things happen, but it's a good question. It's something to really, pay attention to. We have a pretty disciplined approach, to what we're trying to do.
And this, you have to base this off the CPI report, which is one data point.
Yeah.
And we don't know if it's, inflation could be even more sticky. We had CPI going down for a while in the middle of the year, and then it rose again. And so there's questions: is this just is there going to be a continuation of the trend?
Yeah, because the next CPI report is December 13th. And so is it down farther? That's a good thing for the market. It would really like that a lot, because that denotes trend, because that's what we're looking at here. Is it up? Oh boy. So that means that basically the last report was an aberration, because we've been going up prior to that. That's a bad thing. Of course, the Federal Reserve meeting is the next day. They're always trying to bring down the market, because they really don't want to see the market skyrocketing here, because it makes financial conditions looser. So you get a CPI report that's up a little bit versus what we just saw this month, and then you get the Fed meeting the next day. That would be a hard environment for the stock market to do fantastic in. But so it is one data point, so that's why we're being cautious. All right. Do we have room for one more?
Yeah. Should we be concerned about the debt ceiling coming up?
Yeah. So this has been in the news a lot. The election is still ongoing.
Yeah.
We don't know who controls either the Senate or the House. There's some leaning one way or another. Like, I'd say it's probably leaning towards the Democrats controlling the Senate and leaning towards the Republicans controlling the House. But it's not done, and there's actually quite a bit left to go to find out. We probably won't find out until next week, really. But let's say that the Republicans do take the House. There's been talk that they're going to try to use the increase in the debt ceiling as leverage to try to get some concessions on some of the spending that's happening, even concessions on cutting back on things like Social Security and such. And talk is talk. We'll see what really happens. But we have had in the last 2 times that the debt ceiling came up a very, very scary scenario for me, where there was lots of discussions about letting us default on our debt. And the market dropped 10% the first time, and this was in 2021, last year, and then another 5% the second time, which is not a big deal, but it happened fairly quickly. Because if we ever actually didn't increase the debt ceiling and defaulted on some of our debt, you would be, you would be unbelievably amazed at how bad the stock market would do. I won't even tell you what I think it's going to do. It's too scary. And so that's why the market does respond to that. So theoretically, that is something we face, depending on what the end result is from the election. So it's something to look at and be concerned with. Having said that, even when it did drop 5 and 10%, once they signed it and did it, and calmer minds came to the table, the market came right back. So it's not a big deal. I still tend to get a little bit conservative during those periods of time, because the actual default could be so dramatic. And I think that you got to be careful there. It's sort of moving towards the edge of a cliff. Build a little parachute at least. But generally speaking, these things are just political, have been so far, and the market comes right back. Matter of fact, you could make an argument that it's a buying point, which is why when we had the 10% drop the first time, we had a 5% drop the next time. Because I think buying comes in and says, oh, this is just politics. We can buy at this lower point, and then it bounces back. You make your money. So, but it's not a fun thing to deal with, that's for sure. We'll see. I'd rather, the whole concept of debt ceiling to me is kind of crazy. I think we're the only country in the developed country in the world that has this thing. And it really wasn't designed for what's happening here, where the Congress has to approve an increase in debt. They should get rid of it, but it's still here, unfortunately. All right, well, that's our show for today. Really happy that you could join us today. Looking forward to being able to talk to you again next week. Of course, send in questions. Send them in now. Send them in next week. The Ask Tom at talkmoneywithtom.com email address is the place to go. You can also obviously subscribe to our channel if you want to continue to get notified when we get new content that becomes available. And then you can set an appointment with us if you'd like. Easton and I would be happy to talk to you. Just answer your questions one-on-one. You go to our website, book an appointments up on the top there, and pick a 30-minute time to chat with Easton and I through phone or video. So look forward to seeing you again next Friday, and thank you very much for coming today. Thank you.